Hi, guys, and welcome to the second episode of WTW, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Um, First, it should be noted that this is Thanksgiving Day week, so it was a shortened week, only 4 trading days. But that doesn't mean that nothing happened. It was fairly active. So let's get into it. Okay, first I'd like to make an amendment because last week we set up our macro framework. This is because we like to operate from a macro perspective first so that we can have some kind of tailwind behind us when making trading decisions. So we establish a macro framework and we base all of the information that we get for the week and the weeks going forward on this macro framework. This helps us because a lot of the time, most of the information that you see in the markets is just noise. Things that happen on an intraday basis is like mostly noise. And this is why day trading usually doesn't work because you're just reacting to every piece of news out there or every little blip or move or liquidity flow, and it's maddening. So that's why we need to take a step back, look at things from a wider lens, develop a framework to determine whether something is noise or something is actual signal. Okay, so how we do this, at least how I do it, is I have a macro framework upon which I operate in that was introduced in the first episode. And then I base all news on that to see if it's actionable advice or it's something that I should just ignore. So this is why the macro framework for me is important. Last week we introduced it, but this week I need to make one more amendment. I forgot to mention something last week, and that is item number 12 here. The Fed matters. Okay? Fed policy is one of the most crucial macro points you can have. It will move markets, and people's expectations of what the Fed will do will move markets. Okay? And having said that, the Fed already knows every piece of information that we mentioned in the top 11 here, everything here. The money supply, their balance sheet, the yield curve, credit spreads, all that the Fed knows. As you can see from last week, we got a lot of the information was gotten from the FRED, which is the Federal Reserve database. So the Fed knows all this, and it acts accordingly. Sometimes it acts proactively, and sometimes it acts reactively. What does that mean? Well, if we go back to here, this is the chart of the S&P 500, the SPY, and it's a daily chart. So let's change it to a weekly chart so I can go back in time. Okay, let's go back in time here to 2019, okay? This is 2020, the big crash. Wait, let's open it. This is 2020, the big crash. But here, like right before that, in October of 2018, the market was going down because the Fed was hiking rates, and it hiked them much higher than expected and much higher than the neutral rate. So the market tanked a lot here, like a 20% drop in like 3-4 months. This was October 2018. This is December 2018. And then the Fed hinted that it's gonna stop rates, and it didn't hint. It actually said we're gonna stop rates, and we're thinking about cutting rates. So they're gonna go into a rate cutting cycle. And they did all that. They hinted for the whole of 2019, but they didn't actually start cutting until here. Okay, when the market started tanking a bit, started showing that it might be falling, so the Fed decided to cut around August. Okay, and then what happened then? Boom, it's up. This is a proactive cut. It cut before things got really, really bad. Okay. Whereas here in 2020, you can see that the Fed started cutting after a big drop in the market, okay, and quickly, just like it did in 2000 and 2008. So the Fed is a big player in markets, and we have to take that into consideration in our macro backdrop. Okay, so I just wanted to add that last point in the macro backdrop. So now that we've adjusted our macro, let's talk about what happened during the week. Okay, so this has been a week. Well, let's get out of here and go back to the daily chart on the S&P 500. Okay, it's adjusted here. As you can see, this arrow points to the days of the week. This is Monday, Tuesday, Wednesday, and Friday. Okay, as you can see, it was a bullish week. We broke to new highs and we closed at highs. This is very bullish. Okay, and done a decent volume. Okay, so we're still our macro backdrop and the technical backdrop supports the macro. So we have everything on our side. Okay, so what happened on Monday? The big news that came out right off the bat was that there's going to be peace in the Middle East, apparently. Netanyahu approved the Lebanon ceasefire, and the market was bid. As you can see, it opened Monday, gap up. Okay, so this gap up had a good effect. I mean, it had a good effect on stocks, but this ceasefire always has a good effect on the markets, but it also has a good effect on things that support the markets. For example, oil. A low oil price, here, oil dropped big. Okay, here we're looking at the U.S. oil. Yes, as you can see, it's still stuck in a downturn. I'm still bearish oil, which is bullish the market. So you're going to have a drop in oil when there's peace in the Middle East, and you're going to have a rise in gold. Okay, a drop in gold. Sorry, excuse me, a drop in gold, because gold is a hedge against geopolitical risk, and when there's lesser risk, we don't really need to hold gold because everything is safe and it's a risk on environment, not a risk off environment. So gold dropped big. Okay, but if you look at the overall picture here, it's still consolidating, staying at these levels after a huge run. Okay, so even though gold went down, look, the rest of the week it started going up. But for now, Monday, the big news was that peace in the Middle East, markets are up, gold is down, and oil is down, which is very, very supportive of the markets. Now, what does that do to our position? We decided to take a position in TLT, which is the long bond, because we felt, if you looked at the last episode, that this giant move, this is like the opposite of yields. So let's just look at the yields. Okay? This is the US 10-year, gapped up big, and around here we decided that this move was way too overdone and rates are going to go down again. Because if you believe that the market is going to go up, which I do because we have a bullish macro backdrop, there is no way that rates can continue to go higher. And we also saw technical reasons like the RSI and other reasons why the technicals will support our fundamental view of yields or rates and that they're going down. And the US 10-year here is the exact opposite of the TLT. So we decided to take a pure play on yields by buying the TLT around here. So now we're up nicely on this. We bought the call spread, the 90s, 98s, and now we're well in the money. Our trade is going with us, thanks to peace in the Middle East. So that's good for our position so far. Let's go back to the S&P 500. What else happened? Well, unfortunately, Bitcoin fell dramatically. Usually Bitcoin goes with the market. Okay, as you can see, this is Monday. Bitcoin fell dramatically because, I guess it's up big. We have no real reason. I mean, generally speaking, Bitcoin goes with the market, but after such a big run, it's bound to consolidate. Okay, so on Monday, you had a huge drop in Bitcoin. Okay, there's no reason to panic. We are still long Bitcoin because we are bullish the market, and being long Bitcoin is like a leveraged play on the market, so we want this position. And as mentioned before, we got rid of Bitcoin. This is actually the market cap of Bitcoin, but if you look at it, let me get here. If you look at it in terms of US dollars, once it hit around 100,000, we decided to sell half our position. We're not panicking because nothing has been broken. It's still consolidating at highs. And this is the Monday. this Monday move should not have scared anybody. We're still way above these levels. So this is just a healthy correction. And as you can see, the RSI was very overbought. Doesn't really mean anything. It's a coincident indicator. But here it brought it back down to within the normal band, so we have enough fuel for another run up. Okay, it's just a healthy move. So you shouldn't have panicked on your Bitcoin position. We also had a lot of other news on Monday. The Dallas Fed Manufacturing Index was minus 2.7, and previously it was minus 3. So it's getting worse. It got better because it's less worse. So we're starting to see manufacturing pick up. And remember last time we talked about the PMIs, the manufacturing and the non-manufacturing or services index. And this piece of information doesn't change our macro view on manufacturing, which is, it's low, but we're hoping to see it tick up again. Okay. Another piece of news that we should be looking at that was mentioned before was that the dismal European Union and UK PMIs are pushing European inflation down. Okay, so I know this is not a big thing, but we want to see how the rest of the world is acting if it could support our bullish thesis, because then we could have a risk on across the board. So what is Europe doing? I like to look at the DAX, which is the German index. On Monday, which is this arrow right here, it's higher, but it closed lower, but it was gapped up higher than the Friday close, which is good. They are following the same narrative that we are following in terms of how they look at their worsening economic picture. Like bad PMIs, manufacturing and services PMIs in the EU or in Germany is a reason to cut rates, which should be bullish and supportive for stocks. Okay, so here we have a situation that is confirmed in the German market where bad news is good news. Okay, so the market went up in Germany. What happened in the UK, which is the FTSE here? Monday, the UK went up. It opened up higher, but then closed down, but still higher than before. And as we can see, if we blow it up a bit, we're still near highs. Okay, it's not crazy down, but we're still near highs. It's not like the US, where we're at record highs. We're still near the high level. So the European markets, I should say, are not imploding, with the exception of CAC, which is the French market. The French market is down, but it's a political story. It has something to do with other things. So, but overall, European PMIs being down supports the negative that rates are coming down, yields are coming down, and the US might feel some pressure to match it by going down as well. So back to the SPY. Okay, and one other thing that came out, which I found interesting, was that for some reason coffee is up a lot. Well, the reason is that there's going to be the Brazilian stockpiles are low. So if you like commodities, which I do, coffee is ripping. So there might be a trade there for you commodity guys. We can go into it later. But that's neither here nor there. I just wanted to throw that in. So back to SPY. On Monday, going up. And one more thing that should be mentioned is that we're tending to see the small caps rip. Okay. This is the IWM, the Russell 2000. As you can see, it broke the highs after a long period of consolidation. It broke the highs, gave it back, covered the gap, and then is coming back to highs again. I'm very bullish small caps. If you were following me on Twitter, I've been very bullish small caps for a while, and I have a number of them in my portfolio. But are those small caps outperforming the rest of the market? That we have to see by using the IWM divided by the SPY. If this is going up, here was when we first mentioned it that it's going higher and should hit this target. We mentioned it around here that this target should get hit, and it did. And now, is it outperforming? No. SPY is still stronger, relatively speaking, than IWM, and we should see this go higher if small caps are going to indeed outperform the if small caps IWM are going to outperform the SPY. We should see this going higher. Okay, but this is just a relative chart. If you just look at IWM on its own, you can see that it's going up, series of higher lows, higher highs, breakouts. Okay, and these lines I put in myself, these blue horizontal lines, are key levels. Okay, key levels that are broken. Look at it going back to 2020. After the 2020 crash, it made the highs, and now we're going above these highs. Okay, this is a unique thing. This is a big thing for small caps. It breaks above the old highs. That's big, because in SPY, in the S&P 500, we clearly broke above the old highs at 480 right here, like January of 2024, it broke the old highs. Okay, so IWM needs to really make up ground here. Okay, I'm not saying IWM is going to make this kind of move. You never know, but if a catch-up move is going to happen, this is what we should see on the individual chart of IWM. So if we're going back, we should see a move. Like if I crunch it a bit, we could see a move up to here on a crate, like 300 to 320 fast, if the catch-up move is going to happen. Okay, so just to mention that is to look at the small caps as well. Okay, so let's go back to the SPY. Blow it up here a bit. Okay, this Monday. So what happened on Tuesday? Oh, sorry. One thing I should mention is that the saber rattling with Russia is ongoing. Let's not forget that. Okay, so on Tuesday, which is the green day here, that came to a head. NATO revives talks of sending EU troops to Ukraine. So this is, back to the saber rattling, back to war talk again. And like for me personally as a trader, I don't want to be invested anymore in military industrial complex stocks, MIC stocks, I call them MIC, or defense stocks, because I think that as Trump comes in, there might be a push to peace and they might take a hit. So I played some defense stocks or MIC stocks in 2024, one of my favorite ones. I made a lot of money on one of my favorite ones, which was pretty good. And maybe I'll make a breakdown of that trade in another video. But for now, I want to stay away from defense stocks. Like a lot of retail traders hear that war is in the Middle East is going to flare up, and there's going to be like, Netanyahu wants to create a greater Israel and all this saber rattling going on. But I don't want to be long defense stocks going into the Trump administration. That could change if he decides to become more hawkish than before, or continue what's going on. Then yeah, we'll look to jump back in. But as of now, I don't want to stay in defense stocks, not defensive stocks. That's different. MIC stocks, MIC. So the saber rattling continues. Another thing that happened is the China-Trump tariffs. That's another story that keeps pushing back and forth. You see, these are the kind of stories that people tend to like get whipsawed on. Okay, the saber rattling, the China tariffs. Okay, this is what I mean by having the macro backdrop. Okay, and by the way, that Trump tariff thing bleeds into the bond vigilante theme of lower yields that we talked before with the TLT, or higher yields, because a lot of the traders like Drunken Miller want to have higher rates due to they think inflation picking up. Okay, but we've seen nothing of that right now. Okay, if it doesn't violate the macro, any counter move to your macro should be faded, which is exactly what we did with TLT here. This is the counter. This is the bond vigilante move. TL2 going down because of inflation, higher yields. We see that nothing of the sort has been violated vis-a-vis our macro. So we are not going to fall for the higher yields thing, especially since I think yields are coming down and the market's going up. Okay, the Fed is very accommodative, and I think will continue to stay so. So let's go back to here. And remember, all of this is climbing a wall of worry. We should get worried when we see bad news coming out, like legitimately bad news that affects our macro, and the market is down small or even up. Okay, because then we know that it's not a wall of worry anymore. It's people piling in, not caring about actual bad data, and just going all in into the market. That is a scary time. We are not even close to that yet. Okay? So the big news on Tuesday, well, supposedly big news, apart from what we mentioned, was that the FOMC meetings, the Fed meetings came out. And it was a nothing burger. Nothing really happened. The market didn't, just brushed it off. So nothing to see there. Okay? And like we saw before, the continuation of the Bitcoin drop continued on Tuesday. Still not a panic. It felt, this Monday and Tuesday felt like a panic in Bitcoin. Okay? Like if you felt it, but if you just look at the chart and you look at the macro, nothing really changed. So you should forget about your emotions here. Okay? So Monday and Tuesday was testing you. Okay? And you shouldn't have fallen for it because the macro didn't move anything. Okay? And what other things happened on Tuesday? Oh yeah, the Qualcomm might not take over Intel. There's a big rumors going on that it might take it over. And the reason they gave is due to some deal complexities. So that has an effect on the chip sector. Okay, so we should look at the chip sector because it was a leading sector in the market for all of 2024. Okay, this is, look at that, 2024. This is the beginning of 2024. This is the SMH, which is the semiconductor ETF. Massive rally, okay? Here we're having a consolidation, okay? It hasn't broken down yet. Nothing has been violated. It's still bullish. But now the chips are starting to become, maybe the trade is, if the market goes up, it will go up, but maybe the trade might not be as good as other sectors like the IWM. Maybe we should look at the IWM divided by the SMH. Specifically how small caps are performing vis-a-vis semiconductors. And as you can see, small caps are indeed doing much better against this specific sector of the economy, chips. So it's telling you that the trade might be done and people are starting to rotate their what was previously hot money into a potentially hot new sector, which is the IWM. So as a trader, we should be looking to buy stocks in the IWM. Okay? There are a number there that I like. One of them is SMH. Give you that one. Oh, not SMH, sorry. Sprout Farmers Market, SFM. Okay, I was long that and I'm still staying a bit long. This is getting to be parabolic. Okay, but you can see, go into the IWM, check out some stocks and do your fundamental research here. That's the IWM. Now let's go to SPY. Okay, so we had saber rattling continue on Tuesday. We had Bitcoin continue the drop, and we had yields throughout the whole week. Yields were going down. Okay, contrary to everything that everybody was talking about, inflation ripping again, catching fire again. Okay, we hear people on all these financial news saying that inflation isn't done. Well, we'll see. So what happened Wednesday right before Thanksgiving? Now we're in this red, this day right here. Okay. So on Wednesday, we actually had some good macroeconomic data. We had the GDP growth rate coming out. We had durable goods, and we had initial and continuing claims. Okay. Now the GDP growth rate came in at 2.8%, and the previous one was 3%. So if you can look at our macro, the number one thing we mentioned is GDP is holding between 2 and 3%. So GDP is a lagging indicator. Okay. It just tells us that what we were thinking of 3 months ago is coming to fruition. Okay, so the GDP at 2.8% confirms our bullish narrative and the reason to stay bullish. Okay, The next thing was durable goods. We really don't care about durable goods because they're reflected in the PMIs. And the PMIs, we know that the services PMI, as we saw last week, was high and increasing. And it looks like manufacturing is still decreasing, still contracting, but looking to hold around the 47 level. Okay? So, again, nothing is violated in our macro. And what we should be looking at now is the first part of our macro was GDP, and the second part is jobs holding up. So our initial and continuing claims falling, which is what we like, or steady. Well, yes, they are. Initial claims came in at 213,000, and the previous one was 213. So it's staying right there. And continuing claims, which is another big one, came in at 1.9 million, 1.907 million, and the previous one was 1.908 million. So we're right in line, not going crazy. It's not ripping. It's not going up. So our two big macro factors that are both are lagging indicators are confirming the fact that we should be staying bullish. The macro long thesis is still intact. It hasn't broken down. Okay. So what else came here? Now, we were talking about Bitcoin before. On Tuesday, now, the fear that was felt on Monday and Tuesday almost completely wiped out on Wednesday. Why did this spike in Bitcoin happen on Wednesday? Well, because news that the former CFTC chair is saying that we should have a Bitcoin reserve. It makes a lot of sense. So Bitcoin is number one world's digital currency. So boom, it ripped. So there you go. This fear was almost completely wiped out. Nothing has been violated. Don't go for these big drops. In fact, you shouldn't even care at this point. It takes a long time to turn around this ship. Like if this happened in November 6th, this breakout to new highs, I have these blue lines to indicate significant levels. And this level was breached with high volume on November 6th. Okay, this is when you should be long Bitcoin. Okay, but if we would have seen this and then 2-3 days later it would have fell back in, that would be very bearish. Okay, so that's why I wanted to wait at least a week before knowing that this is going to be real. Okay, and then we can start trumpeting it. And now we're trumpeting it because it is real. It's staying at highs. Now, could it fall over? Of course it can. But I like this fear here because people were really scared during this move because we could power to another leg higher. Okay, so our fundamentals in Bitcoin, the technicals in Bitcoin are supporting our fundamentals. This is a market-driven move. This would not happen if the market isn't strong. Bitcoin is a market proxy. That's the way I look at it. Okay, so we talked about yields. Okay, so another thing that is related to yields is the US dollar. Okay, the US dollar again hit these levels. We're looking at the US dollar here index. Look, the big one, look. We're right at these key levels. This is the all-time highs here. But we're looking at these key levels that hit, just like yields hit. And then with yields going down, the dollar's going down. Because this story is the yield story. The dollar going up is the fact that yields were increasing, okay, especially on the 10-year. And now it's going down. Could it go back up? Yes, but I don't think so. Like if you look at the macro and all the bullish cases, this is probably going to start heading back lower again. It's not going to be a straight line, but it should start heading lower as the market goes higher. So the dollar is confirming our falling rate thesis and bullish market thesis. Okay. And one thing I'd like to mention, okay, that I think I might have forgotten before on gold. Okay. Just because gold went down on Monday due to the peace in the Middle East or Bibi seeking peace with Lebanon, remember, it doesn't violate anything. Okay, the reason it went up is because central banks were buying, and this is not going to stop central banks from buying. Okay, this just resets everything because before, if you look at all the technicals were overbought, and now it resets everything for a potential move higher. Okay, central banks are still buying, and look, after Monday, gold started going up. Now this could be like a little flag to go down, but let's see. We're also entering a period here where we have tax loss selling, and it's getting a little There's going to be some selling pressure going into December. But after that, we're going into very, very, very bullish seasonality for gold. We have bullish fundamentals for gold. And if this goes up again, we'll have the bullish technicals for gold. So everything will be behind gold at that time, because gold will probably rip into March. Okay, the odds are, I shouldn't say probably, but the odds are greater than, I'd say 60% that gold is going to rip and probably break to new highs, maybe go to 300, because here it's like 2,800-ish. Yeah, 2,786. Okay, so let's go back to, I thought I just mentioned that on gold, but let's go back to SPY and then see what happened during the week. So Thursday, nothing really happened. The markets were closed. And on Friday today, again, nothing really big, except, again, more semiconductor news that the U.S. tariffs might not be as punishing as Trump said vis-a-vis China and semiconductors. So, but let's see what happened with SMH on Friday. It went up, but as you can see, it's not like it was before. Okay, before any type of positive news would have it rip. Okay, look at this, boom. Here you're having very good news or positive news, but the market is not buying the fact that chips are going to go into a massive new bull. I think they're going to keep going higher, but it's not going to, like I said, this might not be the sector that you want to be in going forward. Okay, you might want to be in, hint, hint, these guys, small caps. Okay, so everything is fitting together. We have yields going lower as we suspected. We didn't fall for the bond vigilante thing. We have the macro staying bullish. GDP, initial claims, and jobs are still holding up. Nothing crazy. Okay, we're not getting a big destruction in jobs or in initial claims, because as you can see from our previous example, when you have any, well, maybe we can show it again here. Let's see here. Initial claims. Okay, we saw it before. Let's go to 10-year. As you can see for initial claims, oops. Let's go to the max. Let's just blow up this section here. Okay, as you can see, these are recessions. The shaded areas are recessions. And as you can see, initial claims start going up, okay, up here, right before the recession starts, okay? See here, initial claims going up before. In the 1990s, going up before the official recession, going up before the, do we have that now? Let's go 1 year. No, they're going down, 5 years. Okay, let's get rid of this. I don't like, this distorts our view, so let's just look at here. You see they're like flat, going down. This is 2022, this is 2020. They're going down here. They're sort of flat, but if you, let's blow up this area here, they're going down. Okay, we should be worried when they start going up and really going up, like we had during these periods here. Oh, let's go max. Like we had during these periods here. Okay, 2020 destroys our chart, but here we need to see it go up first. So initial claims and continued claims will start going up before the recession hits. And do we see that? No. That's why I don't think we're in danger right now. We might be in the future, but as of right now, this is a bullish market, and we should stay with a bullish trend. Don't be fooled by anything that goes against our macro. Ignore those news. Just look at things that affect the macro and thus will affect the day. And right now, we're bullish.